All right, so let's dive into these ICICI Securities second quarter results, fresh off the press release for 2024. And you know what?
Yeah.
This isn't just your average earnings report. There's a lot brewing beneath the surface.
Yeah, there's a unique twist to this one.
So sure.
This is a company on the cusp of some pretty significant change, becoming a fully owned subsidiary of ICICI Bank.
Exactly. And you know me, I love digging into those little details.
Absolutely.
So listeners, get ready because today's deep dive is going to be particularly juicy. We're going to break it all down for you and try to figure out what these numbers really mean for the future of ICICI Securities.
What's especially interesting is the timing of it all. These results give us a snapshot right at this pivotal moment, almost like a sneak peek at where they might be heading as this restructuring unfolds.
It's like we're getting a behind-the-scenes look at a company in the middle of a transformation.
Huh.
Okay, let's jump right into the numbers. What were some of the key highlights that stood out to you in this quarter's performance?
Well, first off, their revenue breakdown shows just how diverse their income streams are.
Diversity is good, right?
Absolutely, especially in the financial world. So they pulled in a solid $6,325.9 million in interest income.
Okay, holding strong.
Then there's $6,116 million from brokerage
Still a core part of their business.
and another $4,304.3 million flowing in from services.
So they're not putting all their eggs in one basket.
Exactly. They're spreading the risk, which is always a good sign.
Makes sense. But there was this one line item that caught my eye. Net gain on fair value changes. They reported $312.3 million for the quarter. What's the significance of that?
Ah, yes. That figure reflects the changes in the value of their financial assets. Basically, are those assets going up or down in value?
Got it.
And in this case, that gain suggests they're riding a positive wave in the market, at least in some areas of their portfolio.
It's like finding a little extra cash tucked away in your pocket, right?
Sort of, yeah. And what's more, it's a significant jump from the $199.8 million they reported in the same quarter last year.
Ooh, that does suggest some potential growth.
Exactly. It's definitely something to keep an eye on.
Okay, so revenue is looking good, diverse, and some potential bright spots there. But let's talk about the bottom line. Did they deliver on profitability? That's what everyone wants to know.
They did indeed. For the quarter, their profit came in at a very respectable $5,282.5 million.
Solid.
And when we zoom out to the half-year mark, that figure gets even more impressive. $10,541.1 million in profit.
So they're on a roll.
It seems so. This indicates a certain strength and stability in their earnings.
That's music to any investor's ears. And speaking of key metrics, their earnings per share, or EPS, came in at 16.31 for basic and 16.18 for diluted for the quarter. But just a quick reminder for our listeners, because this is an interim report, these figures aren't annualized.
Right, important distinction.
Now, profits are great and all, but they don't come without costs. What were some of the standout figures you noticed on their expense sheet?
Two key areas offer some pretty interesting insights into how they're operating. First, their finance costs. They reached $4,185.9 million for the quarter.
Okay, so that tells us about the cost of their borrowing activities.
Precisely. And that's particularly relevant to their treasury operations.
Makes sense. What was the second area?
Employee benefits. They totaled $3,003.7 million for the quarter.
Which suggests a pretty significant investment in their workforce.
It does seem that way.
And we can't forget about depreciation, amortization, and impairment, which amounted to $385.9 million. But to really grasp the impact of these expenses, we need to look at their core business segments: treasury, broking and distribution, and issuer services and advisory.
Exactly. Breaking it down by segment gives us a much clearer picture of what's really going on. For example, those higher finance costs we talked about, they might be directly related to some strategic moves within their treasury segment.
Right, like they're making big plays behind the scenes.
Exactly. And those employee benefits we discussed could very well reflect growth in their broking and distribution network.
It's like each of these expenses is a clue, and we're piecing together the bigger picture.
I like that. A financial detective story.
Right. Now, before we get too caught up in the numbers, we need to address the elephant in the room: the impending delisting scheme.
Ah, yes, this is where things get really interesting. In essence, this means ICICI Securities is planning to go private, delisting from the stock exchanges and becoming wholly owned by ICICI Bank.
It's a pretty bold move, and it has the potential to drastically reshape their future.
Absolutely.
So, for our listeners who might be shareholders, let's break this down. What does a delisting actually mean for them? What happens to their shares?
So, in a delisting scheme, the parent company, which in this case is ICI Bank,
Huh.
offers a predetermined price for the existing shares. Basically, they're buying back the shares from the public.
It's like they're rolling up the welcome mat and taking the company private.
In a way, yes. It's a way to restructure ownership and take the company off the public market.
Wow, we're already seeing a fascinating picture emerge here of a company at a crossroads making some big moves.
And we're just getting started.
This delisting scheme, it's a big deal, right? Like a corporate shakeup. Can we walk through some of those key dates and decisions so our listeners can really grasp the timeline?
Absolutely. It's like a strategic game plan that's been unfolding for a while now.
Right.
First major move, think back to June 2023.
Okay.
Both ICICI Bank and ICICI Securities, they announced their approval of this draft scheme.
So they're on the same page from the get-go.
Exactly. Then they secured a crucial win last financial year, shareholder approval.
Big hurdle.
Huge. And the momentum kept building. August of this year, the National Company Law Tribunal in Mumbai, they gave it the green light.
Wow, so it's really happening. What's left? What are the next steps before they're officially, like, off the market?
They're in the final stages now, dotting the I's and crossing the T's. Once that's all done, ICICI Securities, they'll officially become a wholly owned subsidiary of ICICI Bank.
It's a pretty dramatic shift.
It is.
I mean, will they even operate in the same way? Like, what changes when you become part of such a large institution?
That's the million-dollar question, isn't it? This move, it could really shake up their entire approach, their strategy. Think about it. Being part of ICICI Bank, that opens doors to a much larger customer base.
Yeah, like a built-in network.
Exactly. And access to a whole new level of resources. It could be a game changer for their market position.
It's like they're leveling up in a big way. But for now, let's switch gears a bit. Back to the nitty-gritty of their financial report.
Okay.
They've got those key ratios tucked away in Annexure A. You know, those figures that give us a glimpse into their financial health.
Ah, yes. The ratios. More than just numbers, really. They tell a story.
They do, don't they? It's like deciphering a secret code. So, for those of us who don't have all the financial ratios memorized, can we break down a few of the key ones?
Of course. For instance, their debt-equity ratio, it stands at 4.93 for the half year.
Okay. For someone who's not a financial expert, what does that actually tell us? Why is that significant?
Good question. The debt-equity ratio, it basically tells us how much debt a company is using to finance its assets compared to its equity.
Okay. So a higher ratio means?
A higher ratio, like the 4.93 we're seeing here, can sometimes be a sign of higher financial risk.
Risky business.
It can be. It suggests they're relying on debt to fuel their growth, which, to be fair, can be a good strategy if it's managed well.
Right. It's all about balance.
Exactly. But it's crucial to look at this ratio in context with other indicators to get the full picture.
So not necessarily a red flag, but something to keep an eye on.
Precisely. And speaking of other indicators, their debt service coverage ratio, it currently sits at 0.10 for the 6 months.
And that means?
That ratio essentially measures a company's ability to, well, meet their debt obligations. Can they pay their debts on time?
Got it.
Generally speaking, a higher ratio is a good sign. It means they're more likely to comfortably cover those obligations.
So 0.10 seems pretty low. Should we be concerned?
It's not uncommon for companies in certain sectors or at certain stages of growth to have a lower ratio,
Okay.
especially if they've got strong cash flows from operations. And in ICI Securities' case, their earnings, they're looking pretty good. So it could just be a reflection of their specific situation.
So they're managing their debt effectively despite the low ratio.
It seems that way, but it's definitely something that analysts and investors will be watching very, very closely as the company goes through this whole transition.
Right, because everything is changing. So what other financial clues can we gather from Annexure A?
Well, there's their interest service coverage ratio. It's sitting at 2.77. And essentially, this tells us about their ability to cover their interest expenses with their earnings.
So can they pay the interest on their debt?
Exactly. And 2.77, that suggests they're in a relatively healthy position, not struggling to make those interest payments.
That's reassuring.
Right. Then there's their current ratio. This one's all about short-term liquidity. Can they meet their short-term obligations?
Okay.
Their ratio is at 1.14.
Meaning?
Meaning they have slightly more current assets than current liabilities. So they've got a little wiggle room to cover those short-term debts.
Gotcha. Now, what about their operating margin? I always hear investors buzzing about that one.
Ah, yes, the operating margin. It's a favorite, and for good reason. It really gives us a sense of a company's operational efficiency. How well are they converting their revenue into profit after taking care of all those operating expenses?
It's like a measure of how well they're running the show, right?
Exactly. And in ICICI Securities' case, they've got a pretty healthy operating margin, 42.38% for the half year.
That sounds impressive. What does that tell us?
It tells us they're managing their costs effectively, they're running a tight ship, and they've got a solid base for profitability.
It's like they're getting their financial ducks in a row.
Exactly. And remember, it's all connected. It's about putting together all these pieces of the puzzle to understand the bigger picture.
It's like we're looking at a company getting ready for a major makeover, right? All these financial indicators, they paint a picture of ICICI Securities present and their potential future.
Absolutely. And it's shaping up to be a really interesting story. This delisting scheme, it's not just about the financials, it's a strategic move, one that could really shake things up in the Indian financial landscape.
So put on your prediction hats for a moment. What do you think? What does this all mean for their future? We've got the delisting underway. We've got their recent performance. What's next for ICICI Securities?
Well, if I had a crystal ball, right? But I do think this move shows a focus on consolidation, on really
Yeah.
leveraging those synergies with ICICI Bank. They've got that extensive network, the resources.
It's like they're teaming up with a heavyweight.
Exactly. And that could mean big things. Expanding their customer base, developing new financial products, maybe even making a move into new sectors within the financial market.
A whole new playing field. So for those of us watching from the sidelines, investors, market watchers, what should we be keeping an eye on as this unfolds?
Well, market share is going to be a big one. Can they leverage this merger to grab a bigger piece of the pie? And then there's the innovation factor. What happens when these two forces combine? Will we see some groundbreaking new financial products or services? It's an exciting time to be paying attention.
It's like they've set the stage for a financial thriller, and we've got front row seats. Well, we've covered a lot of ground today, from breaking down their quarterly results to really digging into the ins and outs of this delisting scheme. Any final words of wisdom for our listeners out there navigating the wild world of financial reports?
Remember, it's not just about the numbers themselves, it's about the story they tell. Look for the trends, look for the insights, and don't be afraid to ask questions.
Love it. And if you really want to get into the weeds, you can find those complete financial reports, all of the juicy details, over on the ICICI Securities website. As for the future of ICICI Securities, well, we'll just have to wait and see what unfolds. But one thing's for sure, we'll be here to break it all down for you. Until next time, happy investing.